In this month's economic update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Michael Pollock, and this month we're speaking to Chief Economist at St George Bank, Hans Kunnen. Thanks for joining us today, Hans.
Pleasure to be here.
Firstly, looking at Australia, the uncertainty around the election outcome has led some to suggest that Australia's AAA credit rating could be downgraded. Where do you stand on this, and what could be the implications?
Well, they said before the election that they were looking for a path towards budget surplus. If that came under threat, then they would consider it. Following the election, we've already been downgraded from a stable outlook to negative. A minority party, if it's difficult to get a move towards surplus, then yes, we could lose our AAA credit rating. Now, how serious is that? Well, they've done it to the United States. In the United States, funding costs have fallen considerably since that happened. It's not, you can't take it for granted that the loss of your AAA will lead to an increase in your funding costs. It's where you sit relative to the pack. So we're still high up there, and even a cut, it wouldn't be the end of the world, but it does send a signal because we do need to change. Our budget needs fixing, both from the tax side and the savings side. And a AAA credit rating could be a trigger that says to the population, look guys, we do have an issue. It wouldn't be the end of the world, but we really do need to work together, even minority government, and get this fixed.
So turning to the US, Hans, what effect do you expect Brexit to have on the Fed's gradual tightening of monetary policy?
It's playing on their mind. They know that last time they raised rates, it created a bit of volatility, and you throw the layer of Brexit and Europe on that, and it would make them think twice. We still think they will, but not quite yet. Not in July. We think September is still a possibility. The US is growing. Inflation is ticking up a little bit. They need to normalise rates, but they don't want to upset the world financial system. Europe is doing that on its own. They don't want to add fuel to the fire. So yes, it's on their minds.
Just looking at China, what are the major factors contributing to the country's lower projected growth figure of 6.5 to 7% for 2016?
A couple of things there. One is policy. They're trying to move away from the heavy industry exporting mode of production that has served them so well for the last decade. But you can't do that forever. They're trying to shift away from that. Those industries are very labour intensive, so we're not seeing as much job growth there. And there's this transition to services. It's a bit like us. We are transitioning from resources to other stuff. And it's hard for them too. The other fact, of course, is that their economy continues to grow, and you simply cannot maintain that pace the bigger you get. There's no wonder the US economy only grows at about 2% because it's huge, but that 2% is an amazing amount of demand. It's the same in China. It used to grow at 10%, then 8, 7, 6, but that's a function of its size. It is still growing very rapidly and plonking, an entire Australian economy on the globe every year, as it were. So it's a matter of size and it's a matter of policy as it tries to transition. Clearly there's been a slowdown in housing activity as well, and that hasn't helped.
And finally to Europe, Hans, what do you expect to be the main economic outcomes of Brexit for the UK?
There's clearly short term and long term. The short term is utter uncertainty and the brakes that puts on economic activity. The uncertainty about London as a financial centre. If it's not part of the EU, why are EU regulators sitting there? They will have to move. That's thousands of people. Euro clearing houses. It's the potential for job losses in London that have got people scared, and we've seen a number of property funds have to halt redemptions because of the fear of what an exit would do to the commercial property sector of London. And that is immediate. That's immediate. So it could potentially mean a slowdown in the UK economy. Hence, the Bank of England, through their Governor Carney, has said, look, we're ready to do what is required. They've relaxed regulations on banks. Clearly, it's a negative in the short term. Until the mist clears, we won't know, but it's certainly having an impact on London property. With a potential outflow of people from London, other cities, Paris, Dublin, Frankfurt, Amsterdam, are looking to pick up those workers and have headquarters and regulators sit in their cities rather than London.
Thanks very much for your time today, Hans.
It was an absolute pleasure.
That brings us to the end of the August PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.